hit it.
It's Friday, July 17th, 2026, episode 296. I'm Patrick Ceresna.
And I'm Kevin Muir. Then our favorite technical analyst is in a camper van in Italy, so it's a special from the campsite edition of Talking Charts.
All right, Kevin, give us the disclaimer and let's get this interview.
Nothing in the podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the semiconductor earnings rejection syndrome, the Kospi capitulation complex, and finally the Hormuz inflation relapse.
Nobody wants to suffer from those side effects, buddy. Nobody
No,
wants.
they don't.
All right, let's get into the review.
It's my great pleasure to welcome back to the show an old friend, Paul Krake, author of View from the Peak and the brand new released book, Growth Without You, How AI Rewires Work, Wealth, and Investing. Paul, thanks for taking time for us today.
Kev, thank you very much, mate. I really appreciate it. It's great to be back. Hope you're surviving the wildfires and all the stuff that's happening your way.
I feel like I'm on Mars, like, you know, the scene with the orange sky and stuff like that's what it feels like in Toronto these days.
Toronto's turned into Blade Runner overnight.
Or Blade Runner. That's a better one. And by the way, you know, how are you? I know you're Australian by birth, but you identify as, you know, in English, don't you? Like you were a long time in England.
Good question. I've just moved to London, and my better half is from Texas originally, but she's now a British citizen, so she's probably more British than I am. But I think everyone was English. If you lived here, everyone was English for the World Cup. And I think everyone is barracking for Spain in the final. That's what I do know for certain. So
okay, so let's talk about your book. And by the way, it's an absolutely terrific read, and everyone should go grab it. It's on Kindle. I don't know, in Canada it's like $10. It's absolutely beautiful. By the way, I was gonna commend you for the charts. I think I'm gonna be grabbing and reposting some of those charts because they were so well done. And for those who don't know, Paul is his background. He's been on the show numerous times. You're, a hedge fund / newsletter writer. But one of the distinguishing, aspects of you is you being bullish on AI and specifically tech for a long, long time. And you're not one of these just grab hold of the last year and stuff like that. You were truly, as long as I know you, you've been banging the drum on Mag 7 and why they were going to change the world, and you've been spot on correct. So you are, I just want to commend you for that call. And not only that, you have some nuance in it, because it's not like you're just always, just stupidly bullish like Dan Ives. You do have times where you're like, oh, this is getting a little expensive, and you are a trader at heart. But one of the things that you've done is you've gone out and written this book. And it's specifically about AI and how it's going to change the world. One of the things I love about it is that it's not just about, the tech, or it's not just about the markets. It's the whole macro picture. And I thought we'd jump in here because early on in the book, I'm going to read here what you said. The right frame for what is coming out is one that Bill Gates set out in 1996, long before AI was a credible commercial product. In the road ahead, he wrote that people, and I love this quote. He says, people always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10, and warned against being lulled into inaction by the first half of that observation. So why don't you, with that in mind, why don't you kind of sketch out how you see AI and what the mistakes might be that people are making when they're thinking about AI over the next 2 and 10 years?
So, Kev, I think the point actually you brought up, and we talked a little bit about before we press play here, was talking about the whole notion of it's different this time, right? And so we as traders and investors have had it beaten into us by our superiors for decades that it's never different. And I have a sort of a classically trained macro background, right, where top down was everything, policy was everything. Having started, a lot of my career during the Asian crisis, that everything was macro. And the longer I did this, the longer I started to question whether that was true or not. And the idea, and it basically stems back to the London bombing in 2004, I think it was, 2003, 2004. And having lived through 9/11 and seen what that happened there, you have this terrible terrorist attack in London that day. And I looked at the end of the day, I was living in New York at the time, and around lunchtime, I looked at the close of the FTSE, and the FTSE was up on the day. And you go, how the heck is that possible? And you started looking at different geopolitical events as they started to occur, and they just didn't matter to markets over time. And I started just to think why. And good friend of mine who's a macro PM said to me back in 2011, he says, you have to think about it through this lens. Does what's happened in London stop a fund manager in St. Louis from buying Google? And it's a really telling thing that makes you think that earnings for an equity perspective is the only thing that matters, right? So I started to look at macro in terms of why the things that we take as a given don't work in the real world. Why does the Phillips curve not work? Shortage of labor, prices go up, inflation. Phillips curve doesn't work. Why does printing money for years not work? I started my career looking at Japan, and Japan's been printing money for the last 35 odd years. Never had an inflation in Japan. And why was that? Well, people always make excuses for Japan around demographics. And in Europe, it was about the EU in 2011 when they printed money over Greece and all this sort of stuff. And the US was about the Great Stagnation. And we keep making excuses for these things that we think are givens versus challenging the underlying principle themselves. And so we talk about cyclicality a lot, and about economic cycles, and all the models that we build on portfolio management revolve around a cyclical world. And yet, since we haven't had an organic recession in the United States, excluding COVID, and let's conclude COVID was an exogenous shock, right?
Okay.
We haven't had an organic business cycle recession in the US in 17 years. Outside of COVID, you haven't had one in 30 years in the Netherlands or Australia. So how can you say that the world is cyclical if we don't have recessions? Now, the book goes into whether it's policy driven and printing money and government intervention, all this sort of stuff. And there's a slew of studies that say that at best that's ambiguous to whether it affects things. And for me, the best example of this is that T. Rowe Price back in 2015 looked at corporate margins in the US. And they went from 1% in 1975 to 8% in 2015, and they're close to 15% today, right? And ran the numbers on what drove that margin expansion. And only 130 basis points, right? And it's 130 basis points from 15% under Volcker down to 0 in 2020. Well, at the time, it's basically 0 in 2015. Only 130 basis points of the increase in margin could be attributed to lower interest rates and lower taxes.
Okay.
Everything else was innovation. So it drew me, and that's the standardization of container ships back in the 70s, globalization, enterprise software, cloud computing, the internet, mobile, all these things add up and up and up, and you're getting these great margin expansion stories. So I started looking at this, and I drew the conclusion, which again is a loose conclusion, but this is what I drew, is that maybe economic cycles were nothing more than technology problems waiting to get solved. And as company, if you think the US economy or any economy is nothing more than hundreds of millions of consumers, hundreds of thousands of companies, and probably too much government, right? The consumer and the corporate side of things for the last 50 years has done nothing but get better information, become more efficient, make things cheaper, make things, inventories have collapsed, margins have improved. Every part of the process of making stuff has gotten easier and more efficient over time. And so if you look at a chart of economic volatility, standard deviation of GDP, right? And inventory to sales ratios, days of inventory ratios. If you look at the inverse of profit margins, right? They all go in the same direction simultaneously, which says to me that as technology has improved companies, and things have gotten more efficient, and economic friction's been taken out of the equation,
Okay.
right? The GDP volatility has gone down, and the actual rate of GDP has actually fallen because your boom busts don't exist.
Okay.
And so, yeah, sorry.
Well, I just, I wanted to jump in here because in your book you actually quote Jeremy Grantham, and this is something that I quote that is near and dear to my heart, and I would love to hear your explanation of it. And Jeremy Grantham says profit margins are probably the most mean reverting series in finance, and if profit margins do not mean revert, then something has gone badly wrong with capitalism. So you could have your argument that technology is making the world more efficient, but yet it doesn't explain why we're not getting competition down and we're getting why profits continue to be a larger and larger role. Because let's say, for example, in China, where they actually have more competition, they compete away profits, and we aren't competing away profits the same way.
Exactly. So what you had is when you had a recession every 4 to 5 years, right? You'd have these boom bust cycles, right? And what happened? Traditional cycle is, invest, overinvest, inflation, Fed raises rates, but growth starts to stall, overinvested, over leveraged, companies go bankrupt, Fed guts, repeat cycle. As you and I have talked about many, many times, I think the overriding theme of the last 25 years, predominantly in the United States, but less extent Europe, is the absence of bankruptcies of major companies. They just aren't allowed to go. They're not allowed. They don't go bankrupt for organic reasons. And by the way, if you're strategically important and there's ever a problem like Silicon Valley Bank or anything like that, regardless of the economic condition, Fed's going to throw hundreds of billions of dollars at the problem to prevent those bankruptcies. So previously what you had opportunities for companies who had new technologies and new innovations to go in and fill the gaps of those companies that went under. Okay. Right. And you always had rotation of sectors and all this sort of stuff through that time. But what you've seen, particularly since 2008, is that large companies have just gotten larger and larger and larger. And what that enables them to do is to dominate the capex spend and the innovation spend that keeps them in their prevailing, in the US, most of US case, oligopolistic and monopolistic positions, right? Because there's no more monopolistic economy than the United States. China's so much more competitive than the US is. Europe is so much more competitive than the US is, right? Because you have dominance in healthcare, groceries, airlines, cars, biotech. Banking is dominated by the top 10 banks. Social media is an oligopoly, right? YouTube is effectively a monopoly in itself, right? And so these companies don't get stressed. And so if you have very lax anti-competition laws, which you do in the United States, right? It means that Google and Meta, so Meta can go off and buy Instagram for $1 billion or buy WhatsApp for $20 billion, which probably wouldn't have been allowed to happen in Europe. And by doing so, they stifle competition, right? So Snap is a great example of a company that should have been able to compete with Meta and TikTok and the like, but couldn't because it was basically crushed by Meta's competition. And so if you are preventing if the bigger are just getting bigger and bigger and bigger, and the reality is that the US is a very underregulated market versus everything else, right? Particularly in tech, right? Which is where obviously where AI is heading, right? This is where it's the dominant thing. So you've got these companies that are getting bigger and bigger and bigger. And if you combine that with the lack of cyclicality that's stemming from the fact we just don't have boom bust cycles like we used to, right? Okay. It means the entrenched stay more entrenched.
Okay. And so given that, let's talk specifically about AI and how it's going to change the world, because I think if I'm correct that you're actually, although you're an AI bull and you foresee lots of change, it's not going to be painless.
No, far from it, and far from it.
Yeah.
And so if I'm right, and that innovation has been the driver that has reduced economic volatility and prevented boom bust cycles, well, AI, and by the way, that's been done by the removal of economic friction from companies, right?
Okay.
The last layer of economic friction that exists for companies is human cognition, right? It's decision making. So if you can replace expensive human cognition with cheaper artificial cognition or cognition as a service, what you've done is, for most companies, reduce that last layer of friction to an automated process. Now, let me be clear. We are nowhere near that yet, right?
Right.
We can target the bottom 10% of workers now. AI is a great tool for folks like us to utilize, and we're more productive and all this sort of stuff. But we're not at the unemployment stage yet, right? So it's the great age for AI right now, because you and I and everyone on this listening to this podcast can become hugely productive in the next 5 years, and it's a great. I'll get into the sort of market emphasis in a minute, but at the end of the day, if you believe technology reduces economic volatility, which I think we can say we found enough evidence that it does.
Okay.
That if this tool, as it gets better and better and better, which I believe it will, right, it will remove more economic friction from the equation, make companies hugely more profitable, because it targets the biggest expense for most companies, which is human cognition. And that's where the whole thing starts to feed on itself into what I call eventually a post-cyclical world.
As you were saying that about the fact that you believe that technology is the reason that boom and bust cycles are gone, I was thinking about how many economists might be listening that will be very offended by that remark, because some might argue that they are doing a better job managing the economy. Yep. I take it you probably don't agree with that. Why don't you explain why you don't think it's a better management of the economy through the economists as opposed to technology?
Right. So well, a couple of things. One is, if you look at a slew of studies on the impacts of QE and fiscal expansion, there's no relationship between the size of government and the rate of economic volatility. Right. Okay. So Germany, for historically, outside of the last 15 years, historically ran a larger sort of social surplus in terms of handouts and the like to its citizens than the US ever did. And German volatility was more, you would expect, if that would dampen volatility, then Germany should have a less volatile economy. It didn't. Right. Oh. And France didn't, and Italy didn't, and the like. So there's no academic evidence, right? There's no statistical evidence that says that spending reduces economic volatility. We've all seen the studies on QE. Yes, it affected asset prices, but there's no real impact. Again, the counterfactual argument, well, how bad would growth have been if we didn't do QE? Well, you can never argue against that, right? But there's not a lot of evidence outside of the wealth effect and jacking up asset prices and bringing down bond yields that QE actually had that much impact on stabilizing growth, because growth was actually volatility was actually declining. Economic volatility was actually declining prior to 08, right? Okay. Prior to the need for QE and the 10 odd years of QE that we had in the US, and obviously the same in Europe as well.
I'm just thinking through this argument. Then during other periods of innovation, was there less economic volatility? Because kind of like when you think about it just quickly, I would have argued that it would be the opposite. The more innovation, the more economic volatility that you get.
Well, you don't get the well, because economic volatility, because innovation takes so long to be deployed. Okay. Right. And this is all the arguments about there's no ROI in AI, right? Well, there's no ROI 4 years into the internet either. Right. And electricity had terrible ROIs back in the first 4 years because you didn't know what to do with it. Right. And there was all this trial and error and your stuff. And so it takes a long time for major innovations. Right. And we've got to be careful about how we define a major innovation. So Robert Gordon, the guru himself, Northwestern economics professor, the guy who knows more about productivity than you and I will know about anything. Yeah? Wrote the Bible called The Rise and Fall of American Growth, and it's the history of productivity in the US.
Okay.
And it's a 900-page book that would bore the shit out of most people, and you and I would love it. And do love it.
I think you should speak for yourself there, buddy.
It's the best. It literally there's sections in this talking about the standardization of nails that allowed the condo boom in Chicago in the 1920s. This sort of stuff.
Really?
Right? Oh yeah, it's amazing. And so, but Gordon talks about the special century, and the special century was 1870 to 1970. And he talks about particularly the period 1870 to 1940 as the greatest innovation the world's ever seen. And frankly, iPhones, internet, computerization has got nothing on electricity, on flight, on combustion engines, on indoor plumbing. Indoor plumbing raised life expectancies by about 10 years over about a 40-year period, just because of sanitation. Refrigeration, being able to transport meat and keep meat fresh, or transport fruit from California to Chicago and stuff like that. So these innovations were just incredible, right? But they did take time to flow through. And so there were fits and starts of productivity. So productivity in 1910 was sub 1% during, as Roosevelt was in power and the like. But by mid-1920s, it got to 5.5%, right? And that's after 15 years of automobiles, manufacturing boom. Agriculture had just started to decline at the start of the 20s, really. But it takes time. And so you do have a dampening of volatility, but in those periods, but you still had more boom bust cycles, even though recessions became less frequent over time.
Okay, I got it. So you're sitting here and you foresee this productivity that we've been experiencing for the past, couple of decades as technology has become more prevalent to only increase. Why don't you highlight what the negatives are about that in terms of how society is constructed and what that might mean for how our economy evolves from here?
Got it. So what we need to be very careful about, and I do it all the time, and everybody does it, is to equate the word productivity with innovation. So productivity's got a couple of definitions, right? So in an economic sense, and like in a GDP sense, right? What is GDP? GDP is how many workers you've got, how many hours they work, and how productive they are, right? Okay. And so when you deploy electricity, right, you can make a lot. You as an individual can make a lot more things. So you go from using a hand sew. You're making clothes. So you sew clothes by hand. You can make X shirts an hour. You have an electric sewing machine, you can make 10x per hour, right? You make more stuff, right? Robert Gordon would argue, and the book argues, that the innovation that we saw with computerization, enterprise software, globalization, all that sort of stuff, made things cheaper. One side of the equation is revenue for companies. Okay. The other side of the equation is less cost. AI is less cost. Now, we can talk about different industries popping up and all this sort of thing, but the conclusion I make in the book, jumping right to the end, is AI as a long-term as a growth killer, right? At putting data center rollouts and all that sort of stuff to one side, because you make things so much more. It's all about cost. Why was there not a lot of productivity growth between 1980, a little bit between 95 and 2004, but literally between 1980 and 2010, we had pretty shitty productivity globally, right? Robert Solow once said that computerization is everywhere except in the productivity statistics, right? And the reason is that a lot of innovation like cloud, enterprise software, cloud, all this stuff targets cost, right? And it doesn't target growth. So a good example, mate, is Encyclopedia Britannica, right? We used to have, we had the mum still got our 1980s Encyclopedia Britannica at home, right?
Okay.
And we paid $800 for Encyclopedia Britannica, which in 1982 was
a lot of money.
A lot of money, right?
Yeah.
And so, so Encyclopedia Britannica was a $250 million business.
Right.
And then it went to zero because suddenly you had Encyclopedia Britannica online, which was Wikipedia, right?
Okay.
But Wikipedia as a contribution to growth is effectively zero because there's
You
no
mean
revenue.
growth as we define it as in
Growth
GDP?
as we define it, right?
Right. Okay.
So if the world goes overnight from Encyclopedia Britannica at $250 million to Wikipedia at zero, that's a hit to GDP. Now, because we just don't measure this stuff correctly, right? And that's the measurement issues, right? And so if AI is targeting cost rather than growth, right? Where's the expansion of the economy coming from, right? Because think of the US economy like this. US economy is, again, number of people, how many hours, how productive they are. Number of people, the labor pool in the US at best is going to be flat going forward, right? Bad demographics and poor immigration. They'll work the same number of hours, but can they make more with less? Potentially quite a bit more, but this is not an economy that's growing really fast because of AI. And then the second thing, and the bigger problem about AI, is that AI is cognition as a service. What do we know about labor? Cost of labor for the last 50 years has gone like that. Because it's not just the cost of labor, it's healthcare, it's real estate, it's everything that goes into, it's the software, it's the seat, it's everything. Compute costs have gone like that. Right. But what we've been able to do now is to overlay, as I said, repeat, it's not there yet, but we're getting there, right? You're overlaying this software on top of this, which is artificial cognition, into this declining cost base, which means that you can replace over time expensive human cognition with cheap artificial cognition. And again, so let's say you're the finance department at Caterpillar, and in 1980 you had 250 odd people, making up this number, right? Today, Caterpillar has about 80 people in finance in North America, right? And why? It's because it uses enterprise software. It probably has SAP and Salesforce and all this sort of stuff, right? Which means the people who are there can do lots more than the 250 people could do back with an abacus, effectively, right?
Okay.
But what's going to happen is over time, that number of 80 is going to go to 60, because that enterprise software, which will then embed AI services into it, and this is why I'm so bullish on software companies, which is a little out of left field, because SAP and Oracle and Salesforce and all these software is going to be embedded in these AI tools, which means you can take your finance department from 80 people to 60 people, and by doing that, you're saving 20 salaries, less the cost of this software, which you're already using anyway.
Okay, I want to jump in here in terms of just this worry that we're going to get this decline in employment. And Isn't this something that is experienced every single time we get new technology? And I think even in my lifetime, I can't remember. I think it was Goldman Sachs or something. I remember at one point they had 200 equity sales traders. I don't know if that's throughout the world or in New York City. And then someone told me it's down to like these are traders actually taking orders. Yep. And then through, computerization of orders and things like that, it was down to like a handful. But it wasn't like Goldman Sachs has less employees. They're still growing. And there's just a whole bunch of people doing different things at Goldman Sachs.
Yep.
So one of the kind of questions I have to you is, why does this new technology, why is it different this time?
Sure. So we went back and looked at every sort of major innovation since 1870 and looked at the transition from one technology to another, right? And the overriding theme in all of this, Kev, is that it's not that you had a new technology that destroyed an old technology, right? So manufacturing didn't wake up one day and just destroy agriculture. When agriculture was in decline, right, which again, so manufacturing, let's call it the start of the Model T around 1910. From 1910 to 1920, manufacturing employment went up by about 12 million jobs, right? over that time, agriculture was roughly flat, right?
Okay.
So two things. One is that the whole notion that people left the farm and went to the factory is complete rubbish, right? Because the manufacturing boom was funded all by migrants coming off ships.
All right.
So
Okay.
it was an immigration boom. And one of the leading causes of the depression was basically the banning of basically immigration went from 500,000 people a year to 20,000 in 1926 because of anti-immigration laws.
Is
And
that true?
basically manufacturing just stopped, just completely stopped, right?
I had
And
no idea.
yeah, so it was one of the big things. I didn't know anything about that before I looked at this. So
That's kind of fascinating, isn't it?
yeah. So not that there's any parallels at the moment, right?
It's not like we look like anything like the 1920s
not
with
at all.
everything else, with the grift and the stock market boom. Nothing at all like the 20s.
Exactly. So the whole thing is, mate, that you had in place the new technology was booming prior to the old sectors going into decline. So
Okay.
when manufacturing took the hit in the 70s and 80s, services were already taking off. When the China shock hit, knowledge work was already really booming, right? This time around, right, you haven't got that you haven't got that industry in place today to pick up the slack, right? So that's point number one. Number two is that people have always had this one advantage over whether it's looms or whether it's steel mills or whatever. We can actually think, right? Robots in auto factories are amazing pieces of equipment. You move them 2 millimeters off kilter and they're done, right? So there's no ability to adapt on the fly, which people do really well, right? We're dexterous, we're mentally dexterous, and we can, not only with our hands, our brains, we can do stuff on the fly, right? The trouble with if you can deploy cognition as a service is that last major skill set that people had, which was the ability to make a decision, right? Suddenly is not a monopoly. It's suddenly competitive, and you're competing with software to do that, right? And so I went to dinner with a bunch of VCs here in London about a month ago, and they were pushing back on this whole Schumpeter, creative destruction thing is basically a law of nature, and we don't know what those industries are and all this sort of stuff. And I said, great, and I get we don't know what they are. Give me an example of what an industry would be. And they turned around straight face and said, life coaches. And what I should have said,
all going to coach each other.
And I said, and I looked at what I should have said was, we're all going to have dating coaches, life coaches, personal trainers, all this sort of stuff. That's not a median household, service. It's a very rich person service, right?
Yeah.
And so, why I believe we're eventually going to go to 10% unemployment in the US by 2035 is because I just don't see today why companies. Well, let me word it let's say it slightly different. Okay, these same VCs who are having dinner with, right? They get thousands of pitch decks every year, whatever the number is, right? Thousands of people starting companies. The one thing that doesn't exist in those pitch decks is how do I employ 1,000 people? Oh, yeah. Every new startup that is happening, right? So my neighbor, right? Lewis is a 30-year-old who just got $250,000 from a group called Antler, which is a pre-seed place, right? AI product that works in warehouses, right? Yeah, they are basically going to outsource every service that they've got. There's him and his partner, his business partner, who's the AI guru, right? Lewis is the CEO. They have nothing in their deck about people they're going to hire. Right. And if we are thinking that, knowledge workers in the United States, you and I are knowledge workers, right? Knowledge workers in the United States make up 45% of the workforce, so about 75 million people. JP Morgan said in the event of a recession, and when AI is taking off into 2032, you could permanently lose 10% of knowledge workers. If you lost 10% of knowledge workers permanently, they are permanently displaced.
Right.
That gets you to 9% unemployment. Right.
Okay.
And so could we have a world where we have 10% less lawyers, 10% less accountants, 10% less social media people, 10% less, less consultants easily, right? Now, they could get rehired, other things over time, but you're competing for the first time. People don't have a monopoly over cognition anymore, and that's the competition.
Okay, so let's talk about this environment where it's 10% unemployment. We haven't had that in a long, long time, and it's been easy to fix, but it might not be so easy to fix this time, right? Because the world is changing in more diverse ways and in different ways. How do you see this playing out? Like if we did get that spike in unemployment?
So you don't have the luxury as a trader. You don't have the luxury to think 10 years forward, right? When I'm indulgent in writing a book, I could talk shit about 10 years forward, and I could pontificate. Right?
But if there's one thing we've learned about the markets, Paul, it's that it kind of things that we think are way off in the future often kind of bite you and come quicker than anyone expects.
That's the Gates argument, right? So
yeah.
But let's assume we don't have a crystal ball that works, but let's break the world up into two 5-year blocks. Right?
Okay.
So let's make it simple. Between now and 2030 and 2030, right? Between now and 2030, what you're going to have is the evolution of AI as a tool, right? And it's an evolution because there are a lot of bottlenecks within the infrastructure, right? You got to generate a lot of new power to fuel these things. There's the infrastructure is difficult. I mean, China's good at infrastructure, but not so good at models. We can talk a little bit about the models later. US is great at models, really bad at deploying energy at scale predominantly because of state regulation and the like. So what you're going to have is these tools, as we've all seen in the last 12 months, they've just gotten exponentially better, right? But we haven't got to the phase yet where unemployment's starting to happen. So Goldman thinks that we're losing about 20,000 jobs a month because of AI, right? Now these people are being picked up, and that's why you haven't seen a dramatic increase in unemployment. But what my guess is this is a non-linear path, right? So for the next 2 years, you might get 0.2 or 0.3 higher unemployment. So by the end of 2028, you might be 5.5% unemployment, just maybe you're heading a little higher than that. And then, but as the tools get better and better and better, you're going to lose 0.4% a year, 0.5% a year, 0.6%. Okay. And suddenly we're waking up and we're losing 80,000 jobs a month, and it's close to 1 million jobs a year are being lost. And that's where the thing really starts to shoot up as the products get better, the adoption rates get more concentrated, we get more broad, right? Again, so at the moment we're probably targeting the bottom 10% of workers, right?
Okay.
Most big firms anyway probably get rid of the bottom 10% every year anyway. So what they're doing is they're getting rid of the bottom 10% and not replacing them. Right.
That's a pretty big deal, Paul. Like we need every job we can get. And 100%. If we go from not, I think even the threat of AI is causing companies to put their hands in their pockets and stop hiring.
Oh, I think it's a really great excuse because we're in this amazing productivity phase right now, right? Yeah. It's the rise of the 55-year-old man. Right, I was so bearish.
How did you know my age exactly?
Well, because that's me. So I was really super bearish on 55-year-old dudes, and I can say that because I'm one of them, right? And because remember back in 2021, 2022, banks weren't just not hiring guys of our age, right? Because we were generally speaking, they were too expensive. They were not as energetic as hiring 2 28-year-olds. It was cheaper to hire 2 28-year-olds. We were screwed, right?
Yeah.
Suddenly then AI turns up and the old dudes know the questions to ask.
Ah, okay. I hear you.
We're good at asking the right questions, right? And so if I'm sitting there with my 19-year-old, and Angus is far better at this than I am, right? But I know if it's a finance related thing, I know what questions to ask, and so I can get around a little better than him because I've been doing this longer, right?
Yeah, I'm the same way. I've been doing some programming with my son, and he is like a computer engineer. In essence, he's way better than me. But when it comes to actually implementing that in the real world, I'm like, in terms of finance, I'm like, no, this is how this works, and you have to have that
You know how to get to the
knowledge.
right answer,
Yeah.
right? And
Uh,
so I think that so this pathway, it's going to be, we'll just do it. It's a lack of hiring right now. So the JOLTS data is really interesting, right? So JOLTS is what, at 3.2%, I think the JOLTS rate is currently, the hiring
yeah.
rate. That's back to where the US was in 2008 in terms
Yeah.
of hiring intention, right? So hiring has collapsed, and you've looked at any metric around college hiring is not as robust. Law law graduates are struggling. These sort of classic knowledge workers are struggling to get jobs, and there's a global, wouldn't call it a hiring freeze per se, but people are being much more selective in who they hire and what they hire for.
Right. One of the things you mentioned there was the fact that, like, it's the rise of the 55-year-old workers. And one of the things I think is interesting is that you're already seeing a lot of pushback in terms of AI. We had that situation where at 4 different commencement speeches, an old dude like us got up and tried to, talk about how great it was, and they got booed off the stage. Do the young people realize this? Like, I guess they do realize this problem. And do you think that this will increasingly be something that ushers in more animosity between the generations?
So I am doing a talk at the Student Union of the London School of Economics in about 2 months' time, right?
Okay.
No, they don't know who I am, right? No one's read my book there. It's sold out.
It's sold out.
It's all because of the topic. It's not about me. It's got nothing to do with me. It's all about the topic. Right? All about the topic.
It's sold out because it's a great book.
Yeah. So, but I'll give you mate. I'll give you. This is what inspired me to write this. Sort of go down the path I did. So I took Angus is now he's now a sophomore at Northeastern University in Boston. Right.
Okay. This is your son.
Last December.
Yeah.
So last December, when he was a freshman, I went there and I took a bunch of his mates out for dinner. And there was a third year student there, third year computer science, and he said to me, "Mr. Krake, when I came to Northeast, everything was just awesome, and now I fear I'm unemployable."
Wow.
And you go, that's the sort of, pardon the language, it's the last fucking thing you need to hear from a 20-year-old. It's really sad, right?
Yeah.
And they get it. They understand this is coming. Right. And that's at a very good university, top 50, top 75 university in the country at Northeastern. But, where do all these kids get absorbed into? Right. So if you're a law graduate, for example, and your firm is using Co-Counsel, which is the Thomson Reuters product, right?
Okay.
Does it hallucinate? Yeah, it does, but it's still a good database. It's not like it's where these hallucinations about fake court cases happens.
Yeah.
It's outside databases, and
Okay.
it's not a closed database like Thomson Reuters, but effectively it makes an error rate of about 0.2%.
Oh,
right?
wow. That's
And
like
so,
nothing.
which is roughly the same error rates as what a first, second, or third year associate would make.
Right.
Co-Counsel costs about $20,000 a year per seat,
Yeah.
versus $400,000 a year all in cost for an associate.
Wow.
And so law firms have never been more profitable, but they're scaling back on hiring of new legal grads because this generic stuff that these first, second, third year associates were doing can now be done by Co-Counsel and Harvey and tools like this.
Okay, so I have so many things, but let's try to steer this a little more towards the markets for a little bit, because one of the things, I'm going to read this a quote. You said the United States leads in LLMs because the private sector was left alone to compete. It lags in the infrastructure required to scale those models because the public sector was ideologically prohibited from building it. Both outcomes trace directly to the same governing philosophy. Talk a little bit about how what made America so great and made them win that, and then what's holding us back in terms of the infrastructure and how it will resolve itself.
So China great. Where's that? Where? Let me give a plug to a mate. I can't see it. So I've got a book behind me called Breakneck, which is a book by Dan Wang on basically on China and the US in terms of economic competition and what China does well and what China doesn't do well. China does big projects really well, does engineering really well, does software and innovation much less well, right? And so the reason the US has lagged, well, the reason China has done so well in these big engineering projects is because it can deploy the hundreds of billions of dollars of capital required to build out, whether it's world's biggest world's biggest solar industry, whether it's batteries, whether it's nuclear, whether it's all these things. It doesn't take 8 to 10 years to build a nuclear power plant, right? That's permitting, right? It's 8 to 10 years in Canada and the United States and Australia, if you could do it in Australia, right? Because people don't want this stuff in their backyards. Now, the US is great at doing innovation if it doesn't cost a lot to do it, right? So you can develop software for millions of dollars or tens of millions of dollars because that's the sort of capital that's available from VCs and private equity and the like. So that's why the US has the world's best software companies, because it has the capital scale to do this and the infrastructure to do this, where it doesn't deploy hundreds of billions of dollars well, because going back to the Reagan eras, Reagan thought the government got in the way, and government getting out of the way is great for software and stuff that doesn't take a lot of money to produce. It's not great for airports or high-speed rail or electricity in the right places or all these sorts of big scaled projects. So the last time the US did these big scaled projects, putting the sort of the moon landing to one side, was the highway bill and suburbanization and all that sort of stuff, which was very much government funded. Yeah. Right. But then after Reagan, we stopped doing those big infrastructure projects. Okay. And therefore, that's why the US gets a C or a C plus from the American Association of Engineers on its infrastructure, and its bridges are falling over and all that sort of.
But given how energy intensive AI isn't that going to limit U.S. being able to continue to lead in this category? And
it's a real problem. It's a real problem. It's a real problem. And so their companies, the trouble is not federal, the trouble is state, right? Because again, whether you're California, Pennsylvania, even Texas, which is a very easy place to do business, right? You still have restrictions on, you have a shitty grid in Texas, right? The grid needs to get rebuilt, and who's going to pay for that and stuff like that. So you're going to have you've got major bottlenecks, and the irony is that my negative view on employment actually gets tempered because of the bottlenecks. If you can't produce the power, you can't train the models to be that advanced. And if you can't train the models to be that advanced, people don't lose their jobs at the same rate, right? Wow. So you want to talk about keeping employment high? Well, just keep the bottlenecks. Make sure all the transmission can't be used.
Or even the infrastructure build out to fix things like the grid will be a decade to do, and it'll take a lot of jobs.
All of that, 2 decades, right? So you've got to double electricity production globally by 2050 to deal with, not just AI, but electric, whether it's electric vehicles, decarbonized industrial processes, all these sorts of things. It's about $3 trillion a year we have to spend. Okay, globally, big number.
Let's back up and look at the macro picture, because one of the things that you're arguing is that we are going to see corporations continuing to take a larger and larger piece of the pie. They're going to become more profitable. And so this trend that we've experienced over the last, few decades of labor making less and less and corporates making more and more is going to continue and might even accelerate. One of the problems with that is that we don't tax the corporations. And not only that, we're cutting taxes on corporation. So we have this situation where the government income statement is getting worse and worse as we innovate and as technology becomes more and more prevalent. How does that play out in your mind?
Okay, so I have never been overly bearish historically on US fiscal sustainability. Yes, the US spends too much, but all the arguments being made about rising risk premium and all this sort of stuff, we've never really seen it in the US. We've never really had a sustained period where people were dollar sell-offs, sure, but you've never had a sustained period of rates spiking high because the US couldn't pay its bills, right? And certainly the US does have a spending problem, undeniably so, right? But if you've got the labor share of GDP going like that and the capital share of GDP going like that, you can't have a tax base where 88% of US tax revenue stems from payments from labor, right? From W2s, FICA, all that stuff, right? And so what do we know about labor? Labor is inflexible, not mobile, not really litigious, right? So if let's say I make $300,000 a year and I pay $100,000 in tax, there's not a lot I can do to get that $100,000 down that much. It might go to 80 if I'm lucky, right? But it's still going to be a pretty high number, and particularly a high number if you live in New York, California, or Illinois, right?
I was going to laugh and say you're 300 and you're only getting taxed at 100. You've been living in the States too long, buddy.
Yeah, exactly. So but corporates are about 9% of the tax base, right? And what do we know about corporates? They're flexible, litigious, mobile, and they can go from Illinois to Florida. They can do a Citadel and go from Illinois to Florida. They could be a healthcare company and go from New York to Ireland, right? Yeah. We know about companies. They're going to do everything in their power, which by the way is a shareholder responsibility to do this, right? Everything in their power to minimize their taxes, right? So what we need to, this is not in the book, but I think it's a great idea. Just tax companies at the same rate as you tax people.
Wow, that's a big difference.
Right, but again, and we can even let's lower the top personal tax rate. Let's lower that number down.
Yeah,
but let's make sure that companies on their taxable income pay the right amount of tax.
But isn't that going to be a function then of all the Irish sandwich and all this stuff, right? And then countries start fighting for it. We almost as a global society have to agree that corporations need to be taxed more.
We all are going to face the same problems, okay?
Well, I completely agree with you.
The Irish are going to face the same disruption as everybody else. Right. So, and again, this is not about more tax, right? This is just about spreading the pie. So, for example, the U.S. tax code currently encourages people encourages a company to fire its workers and replace them with software. Actively encourages it.
How does it do that?
How does that do that? Right. So FICA is the FICA is about 7.5%. Right. So anyone who works for a company, the FICA is about 15%. You as a worker pay 7.5%, and the company pays 7.5%. On behalf of.
So I'm sure I don't even know what FICA is. What?
So basically all the payroll, Social Security, Medicare, all that stuff thrown.
Okay. Fair enough. Right? Yep.
So the company pays 7.5% on top of what the person pays, right?
Right.
But let's say you fire that person and replace that person with an algorithm.
Okay.
You don't pay the 7,500.
Right.
You don't pay the FICA. So we're at a stage now where it's more expensive for companies to hire people than it is to deploy software. And again, if you think companies are rational, right, the rational decision for a company to do, if and when the tools are equalized, you get the same amount of benefit out of a software as you do as a person. The logical, rational thing to do is to fire people and replace them with software.
Got it.
And so, should we live in a society and have a government that, by the way, needs to pay for, we have to pay for unemployable people need to be supported, right? Right. So should we have a tax code that actively encourages people to be fired and replaced with software?
Obviously not.
Right.
Okay.
Yes. Yeah.
One of the things you mentioned earlier was you said that you're actually bullish on software. Let's start talking a little shorter term. A lot of this stuff is long term in nature. A little shorter term. Like you say, you're bullish on software. Does that you think the sell off is overdone in the software? Okay.
Our good mate Rupert Mitchell and I have gone. We've had some sort of argy-bargies about this one. So my thinking on this is very straightforward, right? Is that putting valuation, all that stuff to one side, not the sell-off to one side, right? The one thing that AI doesn't change, right, is, and this is why we can talk about the valuation or sort of what are the LLMs worth, which I don't think is a lot, but anyway. But the software provider, who owns the customer, right? At the end of the day, who owns the customer, right? And so if one of the roles of AI is to enhance and make things cheaper, right? Allowing Caterpillar to go from 80 people in finance to 60 people, right? Well, how do you do that? So you do that by, SAP and their financial software adds AI tools into the mix, right? And so you allow these current software offerings, whether it's Salesforce, whether it's around HR, whether around finance, logistics, whatever. Suddenly you deploy the AI tools into those pieces of software to make them more efficient over time. Okay. And so if you're Anthropic, for example, you've got a choice, and your choice is either A, get a 9-figure annual agreement with SAP or Salesforce to deploy your tools, to deploy your back end in these tools, right? Okay. And maybe there's a governance layer, there's governance layers over the top, and there's all these lots of bells and whistles. And by the way, that business is higher margin. You probably you have to eventually inference costs have to go up. So you're covering some inference cost, and that's a profitable business for Anthropic. Or you turn around and go, I'm going to compete with Salesforce, and I'm going to make the next Salesforce. And how do I do that? Well, I have to hire a bunch of salespeople. I've got to compete with Salesforce. I've got to undercut Salesforce. And I go from a business that has unbelievably good margins to a business that has shitty margins. And I'm trying to compete with someone who, by the way, can then go to Mistral or Meta or some of the open source LLMs and do it themselves.
Right. So owning the fact that they already have the customer is like customers are stickier is in essence your argument.
What is the only thing that is a bigger pain in the ass than cleaning your than shutting down and cleaning a storage unit is changing your enterprise software. And so if you're mate, look, I was chatting to a friend who's a chief technology officer at a small public company, right? If he was to deploy an AI to Salesforce, right? He thinks it's 2.5 years of beta testing to get it across the line.
Yeah, I understand. Yeah, no, I get it.
And if it goes wrong, his job's on the line.
By the way, I don't know if I've told you my theory, but I actually think AI is going to level the playing field for smaller businesses. And I'll tell you why. I watched this, PBS report or something, and it was about AI. And it was a small company with 6 or 10 employees, and they did antiques. And, it was a tiny little company, and the guy had always wanted to have shipping, a website, kind of inventory management thing. And when he had gone to go and try to get this stuff, it ended up costing him like 10 grand a month or something like that, which was onerous for him, right? He couldn't afford even the cheapest of the SAP type products. Well, he grabs Claude. He's fairly entrepreneurial and he's smart enough to go and he programs up his own thing. And he says, not only that, the reality is that this is even better than what I got from SAP because I can tailor it to myself. And so one of the things that I believe is that AI is actually most suited for the small, nimble business that doesn't have 2.5 years of getting something over the line and can quickly deploy and do these things. And so I look at it and say, all of a sudden, like, I almost wonder if Amazon is going to be at risk in terms of, like, the only reason I go to Amazon and buy it is because it's so easy. But if all of a sudden my neighborhood, whatever, producer or store retailer has a good website and a good thing and, puts it into Shopify, I'll go there just as easily.
Well, it's probably a great thing for some. I haven't thought about this, but it's a great thing for Shopify and these companies that can aggregate these small businesses, right?
Yeah. But I think small business is where it really shines, because to me, I talk to folks in the banking world, and yeah, they're using it a little bit, but where the people that are using it the most are single small entrepreneurs like you and me. Right, where we can all of a sudden, we don't have some compliance guy telling us, no, we can't do that.
Have governance. Yep. Yeah. All that sort of stuff.
Okay. So that's
just a very good point on that, because that's the reason why the equity, and a bit of a segue here, the equity market's about to change its dynamic and boom for the next 5 years, but it's not a Mag 7 boom. It's an everything else boom.
Okay. Yes. And this is something we spoke about before. Why don't you explain to us where you see the opportunities over the next 5 years? Because, although you've been bullish on Mag 7, you probably are as cautious as you've ever been right now.
Yeah, and we can talk a little bit about the Lucas tree and how they've gone from having these massive free cash flow businesses to, potentially negative free cash flow, and what that should mean for valuation and the like. But at the end of the day, I think eventually we are going to transition from a world of AI providers to AI beneficiaries, right? And the AI, look, it doesn't mean you're short Mag 7 and all this sort of stuff, because if the adoption rates are going to be as high as what I think they will be in the next 5 years, then Amazon's selling a lot of, AWS is selling a lot of compute, and Microsoft's selling a lot of Copilot and all that stuff, right? But what is the dream of every young equity analyst, right? It's to find a company that's going to go from 4% margins to 8% margins. Right.
Okay.
That's what they dream about, right? Amongst other things. And so this is these tools are going to be adopted globally, in a pretty ubiquitous, simultaneous sort of way, right? So, if you're a Brazilian retailer or a German manufacturing company or a Japanese industrial, your ability to cut costs and make things cheaper and take your HR department down by 25%, or logistics down by 25%, or this antique company can source from multiple other providers cheaply and the like. All of that adds margin over time, right? And you can, again, that's why you can go off and do more with, you need less people to do the same amount of stuff, which actually is a GDP productivity. It's a high productivity, may not net off to be more growth, right? But at the end of the day, your margin improvements, you could see companies, particularly US small and mid cap, European mid cap, emerging market companies, they will benefit from this as well. Add 25, 50, 75 basis points a year in margin for 5, 6, 7 years, right? And you don't need a lot of revenue growth on top of that for those companies to be 2, 3, and 4 baggers over that time, right? And so this is owning German equity. This is owning French equity. This is owning, well, Korea. Who the heck knows what's going on there? But but things like Singapore and Brazil and places like that, right? And so the world's going from the AI narrative being dominated by a couple of hundred companies globally, right? About that, to a world where thousands and thousands and thousands, tens of thousands of public and private companies benefit from these tools.
What do folks say to you when you present this argument? Because at first blush, you've made AI and technology kind of your focus. You're extremely knowledgeable about it, and you're actually very much believe it's going to change the world. And then, everyone else is, buying what's on page one, the semiconductors, the memories, and you're saying, no, forget about those. You actually want to own these other things that are actually quite boring and have nothing to do with AI. And I happen to love the trade. I think it's a terrific idea. There's other reasons why I could also argue that it'll do well, but the AI might just be on top of that. But what is the response when you tell people that?
So, what's the response? Mate, I think people have a lot of very preconceived ideas about this. It goes back, basically, got my point right at the start where we're talking about me not knowing if macro really works like it used to, right?
Okay.
And so I think inherently macro people are lazy, right? And
you know what? I won't use that as a title for our show, but I'm so tempted.
Yeah.
Macro people are lazy.
And so, so I had this argument with someone recently who was basically, by the way, how do you're the nicest man you're the nicest man in this industry, right? So you probably don't get people swearing at you. I can't handle social media. There's the dickheads on there is just beyond.
I've turned it off ages ago.
People there.
I turned it off ages ago.
Anyway, so this guy was I think he just started off by calling me a fucking idiot, and that's where he started. Right? so
it went downhill from there.
so tell the truth. But his argument was, it's saying how there's no ROI in this stuff, and that law firms won't use it, and all this sort of stuff. And I said, how many law firms have you spoken to about this? And he says, I don't need to. I just and there's assumptions about all of this. And why I say macro people are lazy. The only way you get to know what AI is doing is to actually ask companies how they're using it, right? So we spend a lot of time talking to companies about how they're using it. And look, there's a lot of money getting wasted. There's a lot of trial and error. There's a lot of companies that have no ROI at the moment at all. They don't see an ROI, but they're still spending, and they're still spending and spending because eventually they think that's coming. And I think it is as well. And so, it really depends on how you've got to be open-minded about this stuff, because, as I said at the start, we've all been trained in it's never different this time,
right?
And I think it is, and I think it is different this time because of this cognition thing that we've talked about. And so, it's pretty hard, given the dominance of tech in the last 15 plus years, right? That it's pretty hard to convince people that this stuff can underperform. Now, if you ask equity people dedicated and you talk about this free cash flow issue, which is a major problem for valuation for tech firms, massive problem, right? They can buy into this argument, right? But you tend to find that macro people, they don't want to hear stories that cycles may be coming to an end, which is one of the things I say in the book, that cycles are coming to an end, right?
Yeah.
That's an outrageous thing to say. And I get why people say you're an idiot for saying that. But again, what is it with, we haven't had a recession in the US in 17 years, right? We haven't had a recession in the Netherlands in 30 years, right? Ex-COVID, of course, right?
Yeah.
There's
COVID doesn't count. I agree. You can take COVID out.
That, right?
Yeah.
And so, I think it's about our training and mindsets that people are struggling with this a little bit.
Okay, we're getting towards the end here. What question, if you were interviewing yourself, what question would you have asked that I have missed?
Why am I wearing that shirt or something like that?
No, it's a great looking shirt.
What's the question that you need to ask?
Like what have we missed talking about that really we should have focused more time on?
I think the Fed is a very interesting part of this.
Okay.
So the relevance of the Fed, right? So we've spent so much time as Walsh has gone through his appointment and about talking about Fed interference and Fed independence, right? I think the bigger issue is Fed relevance. And so we talked a lot about this cyclical world, or the lack of cyclicality in the world, and I believe it's getting worse, and I can understand why people don't believe that, right? But I think the thing that is clear is that if you believe that AI will lead to higher unemployment, right, there's nothing from a liquidity standpoint that can change that, right? Because this is a classic, that's a supply side part of the economy. So, if it evolves in the standard way that people think it will evolve, AI will be, deflationary because there's no wage inflation in a world where unemployment's going up to the extent that I think it could, right?
Yeah.
And that unemployment's rising. Well, what's the Fed Pavlovian response to lower inflation and higher unemployment? Well, cut rates.
Yeah.
And they could well be cutting rates into a decent growth environment, but more to the point, they could be cutting rates into an environment where equities have record margins,
right?
Relatively expensive valuations.
They
right?
could be making everything worse.
They could be making everything worse. And so, the adoption of AI is something that monetary policy can't control. So and by the way, we've got a lot of evidence in the last 15 years that rate cuts have done nothing to stimulate growth in the US.
Well, you listen. You don't have to sell. You don't have to sell me. I'm
talk
like,
about this a lot, right?
Right. Like I'm a somewhat MMT sympathetic belief. Yeah. I believe fiscal is way more the driver than most folks understand. Right.
100%. I agree with you. Card carrying Kev advocate.
And to me, when I hear your talk about this unemployment, I'm like, holy smokes, they're going to try to cut rates, but realistically, they're going to have to just spend more money. And then that is actually going to be really weird at this stage because we've spent too much money as it is, right? Because one of the things that I do believe is that in the days when we had excess savings, it was easy to say the government should spend more. We no longer have excess savings. The world has changed, right? Like the reality is that Trump has changed it. So all countries around the world are spending more. Deficits are going up everywhere. We're going to have capital is going to start competing on a governmental level. And so you're going to see things like Japan bringing it home and stuff. Anyways, that's, probably questions for another day. So let's just end with a couple of fun kind of, I'll hit you up. I didn't prepare you for this. Biggest surprise between now and the end of the year that the markets aren't expecting. Biggest surprise to the upside and downside.
Biggest surprise to the upside is the continuation of chip revenue growth.
Oh, okay.
Right, the continuation of that, because it is frothy every metric you could think of, and whilst I don't believe that the data center overbuild scenario, because I think there's too many bottlenecks in the data center supply chain for there to be overbuilding, right?
Right.
That would be a surprise if revenue growth continued at that pace. Yeah. The downside argument revolves around the ultimate downside argument is pretty bland. It's one of the tech firms saying that we are getting stressed because we're heading to negative free cash flow. And if the one company does it, it's probably Oracle that would look at something like that. That is one thing. But the big thing, I think, my one outlier event for the year is that Chinese LLMs get banned.
Get bad?
Get banned.
Banned. Okay.
Banned in the United States.
Okay, that seems very plausible. How does the market take that? What happens?
I think the market is fine with that, because if it's the one threat to the hyperscalers have got this wrong, we don't need to spend this money, the Chinese are brilliant, they're doing all this stuff on the cheap, and that's fine, and we can talk about where they're getting their training from, that they're actually nicking half of it from Anthropic and all that sort of thing, right?
100%.
But the US in the last 10 years has done nothing but either ban or force sales of Chinese companies that had a data collection capability in the United States. DJI drones, CTE, Huawei. I think eventually BYD gets banned because these cars can collect anything that can collect data at scale has been banned, right? And we were told all along that there was a backdoor in Huawei and ZTE, right? And that's why we couldn't use them in 5G.
Right.
How do we know there's not a backdoor in these open source models? We don't.
Well, isn't the fact that it's open source? Like I'm not defending it. I don't know, but
we don't know. You've still got to download software. You've still got to download these things.
Okay. I think that's a really plausible thing. Back to the what happens if one of these, let's just mention Oracle. Oracle says, "Oh wow, we really messed up, and we have to cut back on spending," or one of these companies misses in a big way.
Yep.
Like if we have a hiccup, how bad is it going to be? Like I'm probably more worried about this than you are, between the correlation, the implied correlation lows, and the cheap fix, and the speculation, the double and triple levered ETFs. I think there's more speculation going on in this than everyone wants to believe. And that if we do get a miss, it could hurt in a big way. You could be absolutely right about the fundamentals. And then in terms of the fundamentals, as we all know, deviate from prices all the time.
All the time. And again, mate, I've written a book that goes 10 years forward, right? There's ebbs and flows within that. Now, again, this is not in my post cyclical world, the noise to signal ratio of downturns is heavily skewed away towards noise. Yeah. Right, because in prior cycles, you didn't, if you had a sell-off, it tend to be a precursor to an earnings downturn. Yeah. That doesn't happen. 7 of the last 8, 10 to 20% corrections in the US have led to no meaningful change in earnings growth.
Okay, right. Can I ask you a question about this in terms of the earnings bubble? I saw it the other day. I clipped the guys from Excess Returns. They had a terrific interview with Ben Inkler. From GMO, and he argued that we potentially could be in an earnings bubble. And one of the things that we need to and think about is that when a company like Microsoft or Amazon or Meta goes and builds or promises to build an one of these big huge data centers, they are immediately like they're spending, or they're promising to spend today, or they are spending today, and then they're depreciating it over for the next 5 to 7 years or whatever it is.
Yep.
So the market's assuming a certain amount of earnings over that period. So earnings are going up because they're spending, and at the same time they're buying chips today. And they're buying chips at inflated rates, like we all know that who was it, Micron or somebody has 85% margins. So the reality is that we not only do we get the spender to have increased earnings, but we also get the receiver of the spender to get increased earnings. So as we've gotten this huge push into the largest infrastructure spend ever, we've had this massive increase in earnings. And that's great as long as the Microns of the world can continue, having 85% margins and continue selling that many chips, and B, that the assumptions about how much the Microsofts and the hyperscalers are going to be able to rent out their compute for actually live up to expectations. And so to me, it doesn't seem like it would take very much for us to have a moment where we go, hey, wait, maybe we've stated this. And although nobody knows why the dot-com bubble burst, one of the theories was that Gartner just said there was a report in early 2000 that said the internet, instead of it growing at like doubling every 180 days, it was only doubling every 270 days, and that was all that it took. And so that's my worry.
Yeah, but look, at the end of the day, you don't know what tends to hit something. It's something innocuous, something which is random and just it takes it, right. So there's no denying that there is massive excess in the system, right? And so it's all about expectations. And so the expectations are very, very elevated at the moment in terms of growth rates. So in the space of writing this book, expectations for data center spending from the 4 big hyperscalers went from $625 billion to $750 billion, because every time it changed, I had to go in and search through all the little bits in the book and find that change, right? I did it 5 times, right? Because it just, every month, something just went up and up, higher and higher, right? And so expectations are incredibly lofty. We know that this is the most I don't want to use the word overexposed, but I'll say the most broadly distributed investment narrative that I've ever seen. Everybody's got it somewhere, right? It's embedded in indices because of high concentration. It's embedded in leveraged ETFs, as you implied. It's everywhere, right?
Right.
And so there's an earnings downgrade or a miss or something like that is, if it goes wrong, it's 20% plus. It's 20%. I can see that.
Okay.
Right? More than that would require a policy issue, regulatory issue. You could easily, in that 20% downturn, you could see a core weave or something like that have a legitimate liquidity condition problem.
Yeah.
You could see Oracle have a legitimate problem, right? And so I'm not saying this is 1999 through 2001 with WorldCom and that sort of thing, right? Because, mate, at the end of the day, the major hyperscalers are still very under-leveraged businesses.
Are we confident of that, though, with all the SPVs?
I think, I've had this debate before. So people say, well, you've got to include rents and stuff like that in the mix. All right.
Yeah.
Okay. If we do that, we have to do the rents on every JP Morgan bank branch. Right. And so you've got to think about these things. And
I just worry about SPVs. Like, to me, maybe it's just a fact of my 55-year-old self, but like every time there was an SPV, it's because you want to hide something. Right? Like the whole purpose of an SPV is to hide something.
Local government financing vehicles in China, right?
Yeah. Well, listen, we can go on forever, but folks, you got to go grab the book. And by the way, this is Paul's own book. He's gone and put his heart and soul into this. It is $10. I implore you all to go and support our good friend, Paul Krake, Growth Without You, How AI Rewires Work, Wealth, and Investing. You can go onto Amazon, you go into your bookstores everywhere except Northeastern University because it's sold out there. And I'm going to leave you with, actually, Paul, I'm going to read the last sentence. Is that okay? I know I'm giving away the ending, but I think
thank you.
It's capital has won. The challenge now is to own enough of it to survive the transition and to remember that compounding only works in a society stable enough to sustain it. Why don't you just tell me why you chose to end with those sentences, and if there's anywhere, if you have a website or anything,
well, I just
feel free to
run everything through Substack, View from the Peak at Substack. But Kev, I chose to end that way because at the end of the day, there's very much a human cost to all of this, all right? And it's very personal for me because I've got a 19-year-old son he and his mates are stressed about their job prospects, and that's 19-year-olds at college shouldn't be stressed about their job prospects, right? And so the idea about this is the US system in particular doesn't have a good history of being able to look after people who are falling through the cracks, and we've got a US Congress that can't regulate social media. How do you think they're going to go at regulating artificial intelligence?
Yeah, that's a
and
great point.
thoughts of, do we have to talk about universal basic income? How do you, if people can't get jobs, how do you fix them? And at the end of the day, this is a white suburban problem, right? This because it's the suburbs of Atlanta and Chicago and it's Greenwich, Connecticut, because it's white collar jobs that are going to be displaced. And you're only as good as the system you support. And the US economy is not designed for 10% structural unemployment.
Right.
And so there's got to be a lot of changes about how we tax and the like. And it doesn't necessarily mean more taxation, but it's just got to be distributed correctly. Because if you don't, thriving markets only work if you've got a foundation of a strong government, strong legal system, strong society. All the stuff that we do day to day in terms of markets goes to shit if there's no social cohesion there.
So folks, go pick it up. Lots of great stuff in there. There's actually a whole section on the 60-40 portfolio, how to kind of create a portfolio that'll survive this that we didn't even get to. Paul, thank you very much for your time.
Thanks,
always great chatting with you.
Thank you, mate. And for everyone, on behalf of everybody who listens to your show every week, you are a breath of fresh air. We all love you. You've got so many fans, and Mate, thank you.
Oh, that's very kind of you to say. Thanks a lot, everyone. Take care. All right, Patrick. Thank you for taking time out of the campfire edition.
Oh, come on, stop it! Don't say that. Just go get to the charts.
Okay, let's get to it. What do you got
All right.
for us?
So listen, let's start off with these inflation numbers. And what we have here is a big miss on the inflation. Well, I wouldn't say miss, but the numbers came in below estimates at minus 40 basis points. But it really is a testament to how much this was an oil supply shock versus real, genuine monetary inflation. Because the moment we go through a multi-month drop in oil, suddenly the inflation's coming in much lower than expected, right? And so it really, to me, was just the collaborating evidence that this was, in fact, supply shock inflation. Do you have any perspective you want to add to that?
I think that was the majority of it. You're absolutely correct, but you could also argue that the tariff effect was weaning. That was happening. I actually also believe the economy might be weaker than folks believe.
Okay,
and that this is what we're seeing in terms of kind of surprises to the downside in inflation. That demand isn't as high. But you're right, and you're highlighting the fact that it was a big, huge miss, or at least versus forecast. I plotted that, by the way, just to kind of get a feel for it. It's been a long time since we missed by 0.4. Yeah. That was a huge, huge thing. I think it was
here is
2008. Oh, was there one in 2020? Okay, yeah, COVID messed it all up or whatever. But
and then you have to go back to 2015. There was a period where we saw these kind of big misses like that as well.
Well, which one are you looking at? Is that CPI or PPI?
No, this is month over month CPI.
Yeah, but because I thought I did it, but I thought it was. Anyways, we're getting.
Oh, maybe were you looking year over year or month over month?
No, I thought it was. Oh, maybe I was doing year over year, and that was the difference. Yeah. That's probably what it was.
Okay. Anyways, let's dive into the charts and really talk about what's just happening here in general about in the markets and how they're absorbing it. Well, first thing, Kev, it's really interesting is just how it's clear that the S&P is no longer sensitive to the Strait of Hormuz headlines. It really has moved to being obviously the AI story, semiconductors, earnings, everything but what the next Trump tweet is. I remember like when we go back to when things were at their, back in March, everyone was literally hinging on every single one of Trump's tweets and the market was responsive to it. We've literally during this entire re-escalation window have seen some of the tightest price action that we've seen in all year.
Yeah.
Like literally they're all inside days. Like it's like the stock market stopped giving a shit. And really the question then becomes, Kev, like what will ultimately then be the catalyst that the market is moving for its next move, either higher or lower? Forget it trying to be over, like I know we have biases, but clearly the re-escalation of the situation but maybe it's just that oil hasn't gotten high enough for the market to care. Like maybe we would need to see oil in $90 or $100 range, and then the stock market will have a response mechanism. Maybe it's just a move back towards $80 is just not yet in the models, like something that is disruptive, right?
Can I just throw in my 2 cents? Is that geopolitics always matters way less than folks believe, right? There was a time when we would sit around and talk about the Russia invading Ukraine, and the market was very concerned about it. And there was a month or two when that's all that mattered. And then eventually the market realizes, adapts to the new reality. And if you look at that war's been going on for what, 4 years now, right? And it doesn't change. It doesn't affect the day-to-day S&P. Now, granted, there could be something, if all of a sudden that escalates in a really negative way, then maybe that does, come back into it. But I would argue that geopolitics are often just priced into it. And as long as this just ends up being a regional conflict between the U.S. and Iran, should it really, is it going to derail the U.S. economy? No. So
I think
therefore,
I'll push back on that. If
well, no,
oil
but
goes high, if oil goes high enough, it
okay,
will
but
be a
the market
disruptor.
is now comfortable that oil isn't going to go high enough. Again, look, I was looking at the Bank of America fund manager survey the other day, and it was like the majority of participants now think oil's no big deal. We can argue about whether that's correct or
Yeah.
not, but to your
But that's
point,
yes.
that's what I'm saying is the market has accepted, and whether it's correct or not, we could discuss, but it is accepted that this is just a regional conflict and it doesn't matter as much as we used to worry about. So,
Right.
absent a real, spike to $200 in oil, I don't think the market's going to care. And it's going to be more interested in earnings than they are about the Strait of Hormuz.
So okay, so let's talk about the S&P in general, though, and more importantly, the things that are driving it right now. So clearly, we'll talk oil in a moment. We can discuss all of the geopolitics. What I wanted to start with is just highlighting that often at the end of major market moves, if this is transitioning to a topping formation, there are periods where they can be for prolonged periods where the market just struggles along its highs. Using just the most recent topping formation that occurred throughout the start of the year, I want to just highlight just how long this took from the peak high back in late October. It really took the market all the way until March to start breaking down. It was like 125 days. I'm going to round it, 100. Let's just, or even say like 120 days. So that way, it took 4 months in order for the market to really get heavy enough to roll over, and this is where I know that you were talking in the past about that it's a here and now thing, but looking here, we're only 44 days off of the peak price. And if this is a broader topping formation, just using that, like this could last all summer
Yeah.
in a meat grinder. And so now that's plausible scenario number one. We just meat grind sideways and then it's a September October story, right? But what the one thing to watch for sure is what happens here in the semiconductors, and this is where we have to go straight to one of the centerpiece places, and that's the Kospi and the South Korean index, which is already 30% off of its highs, and already spending 5-6 days below its 50-day moving average. All rallies are failing, and it's in full distribution mode on the downside. And obviously, SK Hynix lead into the ADR issuance on the U.S. side, taking advantage of its heightened price level to do that issuance. Like the Kospi to me is the first warning sign. Do you have anything you want to add on Kospi before we go to the semis?
No, I'm with you. I
Yeah.
think it's a bubble that's bursting in essence.
It's bursting.
It's like silver.
So
Like
the
it's silver in
semiconductors.
January 20.
Yeah. So one of the things me and you talked about was that the semiconductors were that the Kospi was in many ways a sentiment of when the AI money flows thing could pivot. And what's interesting is that the semiconductors more or less have been selling over the same window. The difference here is they held up much better than the Kospi. But today, while we're recording this a little bit beforehand, but this isn't Friday, we're actually doing this Thursday afternoon, you are having the first attempt for the semis to close below their 50-day moving average. While that's not like a magic thing, I'm not like one of these people that the moving average means something huge, but it is the arbiter of trend that's been defining this bull market till now. And this 570 area more or less on semis on the SMH has been more or less the kind of highs and lows support line pivot. And so if the semis break down really below this level, that really may have ushered in the beginning of a semiconductor sell cycle. And what's interesting is the semis have clearly already started to deteriorate. Kospi has deteriorated. And the one thing we even talked about in this episode just a couple weeks ago was that, can the Mag 7s and hyperscalers kind of take the baton and keep the market cap weighted names going to kind of offset the impact that the semis would have on this market cap weighted index. And I think that the S&P is in many ways very trade range bound, because as these semis are settling this way, the apples of the world are ripping to fresh new highs. You're literally seeing that money rotating into other areas that are these big, huge market cap behemoths that are able to create the counterbalance to keep these market cap weighted indices in a much more balanced positioning. Because if we had a scenario where the mags were selling the same time as the semis, I'm not sure what part of the market cap weighted index would have to be offsetting for the S&P not to be selling.
Yeah.
Do you have any insights on that?
No, I have this thing I make for my letters called Watch Your Bids, and I clip different interviews. And recently I clipped, I think it was Lisa Shallett from Morgan Stanley, the CIO there, and she was talking about how she was rotating, selling the semis, selling the memory stocks, and buying the hyperscaler / mag sevens because they were so cheap. And I think what you're experiencing, what you're seeing right now, is that is occurring across the board. Big money managers are doing that. The real question is, once that rotation, pauses or gets filled, will the mag 7 sag as well? And then will the semis keep going? And that's what I'm worried about. Like the initial stages of the semiconductor correction ends up being okay for the market, because the reality is that they sell those and they quickly go buy mag 7s and send them up. But if the mag 7s start to get sold, like if tech just becomes something, a source of funds, then watch out, because there'll be no bids out there.
So my narrative that I've been sharing at Big Picture Trading is basically look, if the semis sell, the only thing that will keep the S&P 500 afloat is going to be that the mag 7s keep it going. And right now it's working. You can see here, this is the mag 7s ETF. You see it breaking higher. It's right, that rotation is clearly here. And on the short term, it's here, and that may be enough to keep this market boring as hell for the rest of July. And we'll see. Like, for instance, we are in the midst of earnings season. You can see the financials held up. We had JP Morgan, Citi, and Bank of America all come up to bat. And generally, they started a little weak and almost immediately just went ripping higher. Like you can see on the earnings, JP Morgan goes gapping down to a lower low and immediately bought on dip, ripping it to 52-week highs. And so right now the banks are working. The other thing to highlight here, the industrials, XLI, that broke to 52-week highs. This is like a flagging formation. Will like industrials join the party? Like, will we see the kind of higher beta names keep this going, or is there going to be like a big rotation into the defensives? Now, the healthcares have been a big winner, and they continue. Look at this breakout today in the healthcare flagging formation on the upside. Like, we could have this at 170, 175 on the upside. The healthcares and the biotechs just on fire. The biotech's not turning up the same way the healthcare basket did, but definitely we're seeing substantial bull advances now really in this healthcare. And the bigger question for me is, will we see that rotation happen where utility stocks really break out back to their highs? Will we see consumer staple names break these multi-month trade ranges to the upside? Will this kind of defensive sectors take some of this money flow, or is it all mag 7s going to do the lifting? Any insights you want to add on any of that?
No, I don't have any insights, but I do. You mentioned the earnings, and I would argue that we're very early, and a lot of this is still to come out and to play. And yes, of course, the banks have been terrific, but a lot of that has been underwriting because of the buoyant stock and bond market and the huge amount of issuance. So to me, the earnings picture is still up in the air. I'm not going to say that everything is okay yet. It could be. I will push back and say that the expectation for earnings is quite high.
Yes.
I would be really shocked if we're able to meet those expectations like we usually do. And one of the things that I think is interesting is that we've seen more and more, Patrick, is usually we get this decline into the actual earnings of expectations, meaning they walk down numbers. So you'll see it actually that the numbers walk down. Last month, this didn't happen, or last quarter, I'm sorry, this didn't happen, yet the earnings were high enough. Same deal here. There's a huge amount of just good news expected. So it's going to take extremely good earnings news for us to actually keep this market afloat. So I still think that the surprise will be not that the earnings are bad, but that the reactions to the earnings
aren't met.
Yeah.
That's well, you could, that wasn't the case in banks.
No.
So it'll be interesting because the mag, like we're gonna have the one to in my mind to watch is Google out on Wednesday of next week.
Right. But I might argue on the banks, Patrick, that they're not something everyone owns. It's not a story that everyone's like, oh, things are so great, I got to own banks, right? In fact, almost nobody owns banks in terms of, tell me the last time you turn on a podcast and people are like, you got to own U.S. banks. You don't hear that.
The point though I wanted to just highlight here with Google though is, okay, Google's going to come out almost a week before the majority of the other mags.
Okay.
And so what's going to be really interesting, like in many ways, Google was like the centerpiece stock of all of this until they started doing their huge issuance. And I think that what Google says may actually be a nice window into what to expect on the rest of the hyperscalers. And so watching Google's earnings next week is a big one. The other one that's worth mentioning is this vicious decline in IBM.
Oh, yeah. And that was a pre-announcement. We haven't seen those in ages, Patrick.
Yes.
Like, tell me the last time we got something, a big stock pre-announcing. People almost forget what they are. Yeah.
And there was a pre-announce, and it was a vicious one. And it broke it to multi-year lows. Like when you have to go all the way back to 2024 to see price levels like this. And it was a huge percentage gap. I think one of the largest in IBM's history. Like I
think it was back to like it was larger than the 1987 days. It was like you needed to go back to the Nifty 50 days to see a decline of a single day decline.
25% lost a quarter.
Yeah.
Quarter of its market value gone in one day. And so it was a bad day for IBM investors. But the question is IBM really telling you a story about what to expect on a lot of the other, because Mag 7s, the big hyperscalers, might not be as big disappointments, but there's a whole lot of these periphery companies that had some pretty lofty expectations embedded in them. And the question is that, maybe the generals don't get shot in this earnings cycle, but you start seeing a lot of the army going down and getting mowed down, and the breadth of the market really deteriorates. Like that is also a plausible scenario.
All right, let's keep going.
So let's talk crude oil. And so crude gets a bounce back towards 50-day. A little bit surprised actually that it wasn't a more pronounced bounce, but I don't think that changes anything. I'm in your camp because you, at least unless you've changed your view, but I actually don't see any reason why we can't create a full-on 50% retracement, even of the entire drop, which is back to like the $90 to $100 window on crude. I'm not sure I want to go into the camp where we could see 120 to 150 oil. There's still people out there that are talking that, but for us to say that oil somehow belonged down at $68 or $70, I'm not in that camp. The fair value of oil in these kind of conditions is probably somewhere far more in that range, and I wouldn't be shocked if we saw another $10 rise in oil in the weeks to come. Do you have any comments you want to make?
I still think that the crazy numbers to the upside are on the table.
They are on the table.
I wouldn't go and start. Yeah, I wouldn't go and start talking about the surety of it like we did in the past, like the Jeff Rubins, got out there and the end of molecules and stuff. But I still contend that the SPRs were emptied. That was the big surprise. It caught the market off, guard. Eventually, that SPRs we're gonna run out of them, and not only that, on the other side, we're gonna have to, refill them. And so, just like the surprise was to the downside from the SPR, I think the surprise will be to the upside from the SPR.
Yeah. So I want to go to the our website on the cotsignal.com and look at crude oil positioning.
Of course. And folks, go check it out. Cotsignal.com. It is free. There's no sales job. If you want to go and see what's going on in terms of the CFTC, in terms of the positioning in various futures, go. It's a terrific site.
Thank you very much for the plug, Kev. So we talked about this last week about how it was surprising that we didn't see the large specs washed out. And one of the things we both agreed upon was it's probably going to be, it was just, we were looking at back in late June numbers and not in early July numbers. And you can see after that kind of last washout that we got down to the 19th percentile in terms of 1 year look back in terms of positioning. But if you look at the net positions as a function of open interest, that chart on the right hand side here, Kev, what's interesting is we almost got to levels that we were at pre-war in terms of net positioning. And to me, the idea that we would go to levels at or lower than pre-war would have been a surprise. So I wouldn't imagine this getting to underowned where we went down in the 0 percentile, which happened on different commodities. I just didn't think it'd happen on oil because that would just not be warranted in the circumstance. But the fact that we literally are trading at the pre-war levels shows you that all the long speculators that were speculating on the Strait of Hormuz got washed out.
Yeah. Like, and Patrick, you say that the pre-war levels, like they were like some sort of neutral level. That wasn't neutral. People were super bearish oil back then. Yes. Right. And so to me, we are back to the pessimistic people short oil kind of positioning. And that's what we're getting.
Go back to even the 2020-2021 period. I mean, we did, that was like peak bearishness in the when oil was abundance and COVID was throwing all this extra inventory on the system. And I mean, we're not down at that 0 percentile, but we got washed out. Like, this was forced flows. Large specs got one of the most spectacular squeezings, and got washed out. And so to me, there is lots of room for large specs to rebuild their positions. And this is why I think there's more upside. As the Strait of Hormuz, like when you're looking at the 3-2-1 crack spreads, and even here, I just have the Brent crack readily available. We'll just quickly have a quick peek at this one on a line chart. But what I want to simply highlight, like, we are at crazy high levels in terms of these crack spreads. And which is basically showing just the margins are blowing out. Gasoline, diesel, everything's ripping, and so oil naturally can go much higher from here, and the enthusiasm for people to trade it is not that high.
Yeah, and I would contend, Patrick, that the part of the problem is that Trump keeps tweeting stuff to try to talk down the price of it.
Yeah, and everyone's been burned.
Okay, and that's fine. If you actually have a market that's headed lower, that's fine. The real problem now is if there is an escalation, or if we do run out of oil, there is going to be no natural long position to sell into it. There's no speculators long. So if we get a situation where price starts rising because of actual physical demand and supply, there's no cushion. Right? It's kind of like a stock when you say on the upside, right? If you don't allow shorting, it means that when the stock turns, there's no natural buy or not natural. There's no buyers or there's less buyers than if there were shorts because the shorts cushion the decline. And to me, that's what we're getting in reverse in oil. And so I think it's a more dangerous situation than people realize.
And
sorry, go ahead.
No. And listen, I agree. And you know what's amazing to me, Kev, is that that a right tail skew in the options market is so prevalent still. And one of the things that we keep doing at Big Picture Trading is constructing bull call spreads that have these spectacular payoff structures because of that right tail skew, and I think that it's the right way because everyone's nervous that one Trump tweet we back to 70 and I'm gonna take a $10 haircut on oil. You don't have to Delta One this thing. There are a lot of really amazing option strategies that you can put on crude here that'll give you that right tail upside, and you can do so with great payoff structures.
All right, what do you got next?
So I want to talk precious metals, and it's ugly. You can tell me all you want about central banks around the world are still buying kind of argument, but this is nothing short of outright distributive price action. Every rally immediately met with supply. It's a market that continues to be setting up for a potential breakdown move. And one the interesting thing is we talk about the bubble chart on semiconductors, but when you really look at what gold did on a monthly chart here, like it's not exactly a crazy thing for us to have some sort of backfilling reversion on there. Now, I'm not trying to be a bear. All I'm just trying to do is acknowledge that we went through a pretty super bullish event that had sentiment be completely lopsided. Positioning was completely lopsided. And for us to go through a hangover period where gold mean reverts back to a place where it can find a fair value zone and settle in, I think it's still underway. The interesting thing is we're at the round 4,000 number, which is always interesting when you're at round numbers. But the 50% retracement of that monthly chart number is 3,600. And so if we gave back half of the bull run, it's another $400 downside. That to me, though, is still asymmetric. So I don't want to be overly bearish. We are $1,600 off the high, and the 50% retracement is $400 lower. So, at this moment, it's not like you want to start a new shorting thing on gold because it's about to break. To me, at some point, the buy zone is going to come in here. But what if this, right now, real yields continue to rise? You continue to see the dollar pressuring to the upside, even though the last couple of weeks has been a consolidation. This could be a period where the summer could be still very difficult for gold investors. You want to add anything to that?
Nothing. I listen. Chart looks terrible. It feels like it wants to whoosh down to your level. That's all I can say. And I what do I know about reading charts? But it definitely, it's tough to look at that and go, oh, this is great, right? What's our rule? There's no such thing as a triple bottom. It's trying to triple bottom there. It doesn't feel like it wants to do that. I do think what do you call it? Your turtle head?
Yeah.
I could see a whoosh down, a $200 whoosh down that actually then gets immediately bought, right? Like the People's Bank of China is just there ready to buy it. So I'm not. So it feels terrible though.
So go back to the COT chart here. On
COTsignal.com, baby.
There you go. But look at the large specs. But look at that chart of the net positions as a function of open interest, and tell me that the large specs have been washed out, Kev.
They're not. So we need it. So it's coming,
right?
Yeah.
And do you really think just a $200 swoosh is going to wash these guys out?
I think that's a pretty big level. I suspect that you will see some panic. I like if it breaks there, watch all of a sudden everyone talk about how gold's going to 3,000. Like you're sitting there saying, I'm going to buy it down 400, but most people won't.
Well, you know what? All I want is there to be the right macro backdrop and the technicals to start showing that accumulation cycle has begun. And so if we see real yields peak, we have central banks pivoting to more of a dovish positioning, which could still be many months, if not quarters away from them pivoting. We need to see some form of potential dollar weakness, all these kind of macro conditions that typically are really good gold tailwinds. And they're not here. They're not present, which it means to me, I'm going to start with the thing that it's going to be a difficult summer. And then we'll reassess it at the end of the summer to see where we stand. I'm just, again, what's interesting, Kev, is that you have, again, a right tail skew in gold, which makes collaring in your gold positions actually have a positive carry. So you could turn around and just go even 1 month out, wrap in your gold positioning to tighten up a little bit of a hedge to dampen volatility. And you can do it with a positive carry. Like to me, at least dampening some of your gold positioning if one wants to hold through this, at least it pays.
Yeah,
it pays.
I'm scared of all these right tail skews that you're selling, like oil as well. I'm scared of that. I hear what you're saying. You're not really selling them because you're long the at the money or you're long the underlying.
It's an option structure.
Yeah, but to me, the reason these right tails are so expensive is
because the right tail's a real risk.
Yeah.
Right.
I'm not as keen on that.
So,
but I do think, Patrick, here's a real question for you. Gold S&P, like gold over the S&P, what do you think it does over the next summer?
I didn't even look at it, and so I would be just making some shit up if I told you.
But Patrick, that's our shtick.
So if I was to say, like, look, over the summer, I actually think gold can weaken relative to the S&P, but there is going to be a point where the S&P is going to wash out. Like, going back to S&P, like the CTA sell triggers are, closing in on 7,400 based on Goldman Sachs's recent stuff. They're still below there, but there's going to be a point where the systematic sell triggers are going to get kicked in. Right now, the S&P has zero risk of it, the way it's trading in this little tight range on the short term. But we're going to get a point where we're going to have a little washout on the S&P, but there's just zero evidence that it's starting right now. So
okay. So can I jump in here? Because I actually have a view on this. I think that gold might lead the S&P down. So at first, it'll be a whoosh lower in gold if this were to occur. And that would be based on tighter conditions, like liquidity tightening up. And then what I think will happen is that the S&P will follow gold lower. And I am so scared, Patrick, about, like, you go look at the implied correlations in the S&P. That's the 1 year implied S&P correlation is trading at like 12. It's just screaming that there is so much danger out there. There's so much complacency. I think the advent of all these like double and triple ETFs, the amount of speculation.
There's going to be pain.
So I could see a situation where gold is the thing that drags this. It won't be that gold drags the stock market down, but gold will go down first. It'll be more sensitive. It's weaker.
Sure.
And then what'll happen is the SPOOs will follow it lower. And then
and gold will be the first to turn up the moment the Fed has to pivot.
Right. And so to me, I think that if we did get a big move down in gold, like let's say we just got a quick $200, $300 move down, I think you buy gold, sell SPOOs at that time with both fists.
Okay. Now, while I don't believe that gold has, to drop below 3,600 or anything, but I have a little more concern that silver can Eiffel Tower. And maybe gold has a bigger floor, but the kind of high volatility embedded in silver, I wouldn't be shocked if silver took a trip that was down into the 40s before it bangs out its lows. And so maybe the volatility is going to be in some of these sub areas.
Won't disagree there.
All right, so I wanted to briefly touch on some of the commodities outside of that. Particularly, I want to start with wheat, and wheat is attempting to break to a 52-week high. And when you really step back on a weekly chart and look at what we went through, I mean, it peaked out during Ukraine, the start of the war, and it's been a vicious 3-year decline. And suddenly you have the grain markets transition into this, whether it's weather patterns and whether fertilizer shortages because of the Strait of Hormuz. There's obviously a number of people out there talking about that we may have, pressure on food prices going. It looks on the daily chart like wheat has already moved a lot. But when you look on the weekly chart and you look at what wheat has done before 2020, 21, before the war even started, there's lots of room for wheat to even get to the 800 or 1,000 level here on this chart. I think this could be a legit breakout. Now, the corn and soybean have not yet, like soybean maybe more than corn, but you're starting to see these turn up. I think the ags are at least showing signs of bullishness that we are not seeing in a lot of these other commodity spaces.
I couldn't agree more, Patrick. And the other thing is you're talking about wheat on a big picture point of view, how it's relatively cheap and it's done, it's been a lot higher. Put it on an inflation adjusted basis, and it just becomes like
it's like being given away.
Yeah. Now, granted, we become much more efficient at farming. I understand all the reasons why it's cheaper, but I will say that the potential if something goes wrong, if there's some weather or if there's some fertilizer, like I think you're absolutely right that don't underestimate how much wheat could go. By the way, if you're looking to play this, one of the ways, are you pulling up the DBA right now?
Sure. I was looking at the MOO, but the DBA we can start with. The DBA is the agricultural fund ETF. Yeah.
Yeah. So, and it's actually, it's behaving well.
Yeah. The other one though, the MOO that I was just had up here is just the ag business stocks, right? So this isn't any of the actual grains.
Right. So you're not actually long the commodity, you're long the companies.
You're long basically fertilizer and these kind of things, right? But the point is that they have just woken up. It might be in the early stages of turning up. So it'll be really interesting to see whether these ags really get going. But I want to briefly touch on a lot of the other softs, that we don't talk about very often. Yeah, everything from I want to actually particularly talk about coffee and cocoa, and maybe we can touch on orange juice. But let's just get to coffee.
Mortimer.
Absolutely. No, but actually it's a really interesting story. Now, first of all, when you look at on our kind of barometer, we're at the 51% level, right in the dead center when looking at coffee. And it doesn't look like an extreme, but one has to reflect on that net positioning and recognize that we haven't really seen longs starting to meaningfully rebuild exposure after what's been a very difficult 1-year period in the coffee markets. And what's interesting is that so you look here on the net positioning score here. I mean, we spent a 1 year in coffee basically bouncing off persistently the low end range of net positioning, right? And so when we look at the actual chart on coffee futures, you saw basically the big washout on the downside. And then when everything pivoted, a combination of El Nino and the Brazilian crop reports that were coming out, we had a huge breakout in coffee. Now, a little bit is being given back right here. But like I was saying, there hasn't been a rebuild of speculative long positioning at all. And this thing, I think, decisively exited its bear market phase. And I'm very curious to see whether coffee starts being bought on dip here,
All
and
right.
whether or not coffee is meaningfully turning.
All right. So we're
The
watching
next,
coffee. What about OJ?
well, first let's go to cocoa. Let's get
Okay.
to talking some chocolate. Now, again, we're not on the 0 percentile of positioning because we're already off of the lowest levels. But look at the 5-year chart of net positions as a function of open interest. We are literally at 5-year lows
Right.
of positioning in here. Like the longs have not only been washed out, but the longs have actually been net short. Right, like this is just a complete washed out market, and it's just starting to turn. And so here, when we have just a peek on what is actually happening here, you can observe that we went through this like a 2-3 year bear market phase. Let me start with a weekly chart and really just show how the cocoa market went through this vicious decline on the downside for almost a year and a half. And we're just seeing this market turning around. And again, it's pulling back. You've already seen dips being bought back in May and June, and yet the long specs have not started rebuilding those positions. They're still actually net short on their positioning. And so I'm very curious here whether or not we're going to continue to see some squeezing and rebuilding of large spec positioning in the chocolate market here. And then the last one I want to talk about is OJ, right? And orange juice is at the 68th percentile kind of zone, and generally you saw us back in the start of the year actually have large specs in a net short positioning, and it's actually turned higher. Recently it's been pulling back a little bit, but the question here is on OJ is are we actually seeing just pull it up right over here. So, like we are literally trading at the lows of OJ futures, and those it looks like it's actually going to break to fresh new lows. It seems very odd to see this kind of caught positioning at a time when the chart looks like death.
It really does. It reminds me of the gold chart. It just looks like it wants to break.
And so it looks like it wants to break. And yet, we saw this where the long specs really rebuilt at the first part of the year, and they're still generally long. And yet the chart is not collaborating. And I just thought it was super interesting that we're seeing this kind of a divergence, and maybe some trading places or their kind of trade on OJ short might be a interesting position, because there's room for this to still break on the downside here.
Yeah. Well, we're going to call you Mortimer from now on. Or Duke.
There you go.
Yeah, Mortimer Duke. Is that his name? Yeah.
Yes.
Yeah.
We're the Duke and Duke.
Yeah.
All right, buddy. That's all I've got.
That's all you got? Okay.
That's all I got. That's all
right.
I got. We're going to wrap it up and we'll go from.
Well, listen, folks, thanks for tuning in. Bear market, bull market. We're just happy you guys have spent some time with us. Patrick, where can they find out more about your firm and your terrific charts?
Listen, you could check me out, the trades I'm putting on at bigpicturetrading.com. But listen, we were talking a lot about these COT reports. Go to cotsignal.com, completely free, no strings attached. Just go and see what we're talking about here on the show and see how the net positioning has been building on these commitment of trader reports. We wanted to really decode everything and really show a very illustrative way of understanding how everyone is positioned in the markets. And you know what? I'm proud of the way the site has turned out. And so check it out and enjoy it.
All right, everyone. Thanks for tuning in. We'll see you next week. You know what? You want to go to your campfire? We got no beer to review. Yeah.
no beer to review, buddy.
No beer to review. So we'll just call it a day. We'll see everyone next week.
Absolutely. Well, listen, you know what? I just want to make one thing. I am in Italy right now, but
Yeah.
I'm making my way back to Spain. And I'm going to be in Spain during Sunday's final. And so I'll have to send you some footage of the parties if
that'd be
they can
epic.
prevail.
That would be epic.
I think it's going to be pretty.
Who do you like?
pretty awesome.
Obviously, you're rooting for Spain.
Look, I'm going to be in Argentina October, and you know what? No, what's funny is an interesting story is back in when the last World Cup when Argentina won, I actually landed in Argentina the day they won, and I had to go to my hotel by the. I had to go to the my hotel by the obelisk. While there's 5 million fans on the street, so I actually have some really fond memories of Argentina and the World Cup last time. While I'm now going to be in Spain,
I know. I was going to say, Patrick, it's very clear to me that Spain's going to win now.
But if it's not, I'll be in Argentina in October, so I'm gonna cheer.
Patrick, it's gonna be Spain, and
it's a win-win.
It's going to be Spain because you're in Spain. We just have to know your schedule, and then we could bet on it.
2022, I was in Spain in Seville and Sevilla during the Euro Cup when Spain won. So I was there for the Euro. This is a trend. I literally am boots on the ground. Know that I am going to be in Spain on Sunday.
Well, I gotta go. I gotta go change my market in my tourist trap, and because now that I know that you're going to be there, anyways. Have a great week. Best of luck to both teams, and we'll see everyone later.
Cheers,
Take
everyone.
care.